Good debt versus bad debt. How you doing? This is Jerry Parker with Capital Growth Property, talking about different types of debt and how investment properties, investing in real estate and going into debt with real estate can help you pay off some of your bad debts. Is there such a thing as good debt? I mean, doesn't everybody want to be out of debt? Or do you know the difference between good debt and bad debt? Are you buying a lot of toys and borrowing money to do it, for instance? Well, that's bad debt. We're going to talk a little bit about how to structure your finances to help your good debt pay off your bad debt by using your good debt effectively. Your home loan is considered bad debt. We want to pay that off sooner while building your property portfolio. And reduce your tax legally by structuring your finances correctly. Avoid the lending traps that may limit your property investment capacity in the future. Well, is there such a thing as good debt, owing the bank a whole bunch of money? Good debt is considered to be tax deductible debt when you can write the interest off on your taxes. Bad debt is non tax deductible debt. Bad debt is personal debt, your home loan, bad. Personal loans, car loans, credit card debt. Personal loans when you buy things and you borrow money for them. It's all bad debt. Your home loan, you can't write your interest off on your taxes. So we want to drive down your bad debt. 12 golden rules to help you succeed in doing this. Rule one, you must have clear vision of your goals and objectives. You got to have a plan to what you want to do and stick to your plan. You need to be disciplined. Discipline your mind, your body, and your finances for your plan, or at least your finances. Stick to it. You create your own roadmap to help you drive down that bad debt and take it over with good debt. It's important to build your team. This is your entrepreneurial team that gives you the answers to all the questions that you need. You need a good credit advisor or a mortgage broker, a proactive accountant and solicitor, a property focused financial advisor, and a great property facilitator or coach or real estate agent. They need to be working together as a team. And when you have a question, you ask all your team members the question, and then you have the right answer rather than depend on just one person. Rule four, ensure your owner occupied home loan is structured correctly. Now, this is the loan that you take out when you buy the house that you live in. It's important to have multiple loan splits. So, for instance, if your house is $400,000, you got a $300,000 loan, you can split it. A lot of people don't know this. You can split it into, say, three loans, $100,000 each. And you can deal with those loans separately and individually. It gives you more flexibility. Ensure your owner occupied home loan is structured correctly. Multiple offset accounts. So we talked about the $100,000 split ups. Each one of those can have an offset account. That's an account that you can put cash into and it offsets the interest on your loan. Ideally, your loan offers multiple of these offset accounts. Your savings held 100% offset account will reduce the amount of interest that will be calculated daily on your home loan balance. Pay all your income into the offset account. Every dollar that stays in your offset account for one day will reduce the amount of interest that is calculated daily on your home loan. Remember that interest is not tax deductible. Using your offset account effectively will help reduce the amount of interest it will take to repay your home loan. You're effectively reducing it. Redraw facility. This is more about your owner-occupied home loan. A good loan has redraw facilities on the extra payments to make against your home loan. If you make extra payments and reducing the principal amount, you want to be able to redraw that back out if you need to. And that's to give you more flexibility. Property investors frequently structure both their home and their investment loans interest only. This gives you further flexibility. And then you continue to make the payments to reduce your principal, but you want that flexibility to be able to draw it back out rather than a principal and interest loan, and you're making that payment every month, and you can't draw any money back down, so it restricts the amount of cash you have. Number 5, structure investment property loan correctly. Similar type of structure, multi-split, redraw, interest only. Pay your investment property principal amount into your home loan. So if you're making, you want to reduce your home loan first. If you're going to make a principal property, pay off some of the principal on your investment loan, pay off your home loan first. Creates redraw, reduces the interest that you will pay, and helps you pay out that bad debt, your home loan, sooner. The rental income you get from your investment property into your home loan offset accounts. That's one of those 3 accounts we talked about. You put your rental into there. This is where the advantage of multiple accounts comes in to help keep separate your income streams and savings. You also pay your investment property loan from this account. So from your personal income, you can use one of the offsets accounts, and the other offset account you use from the rental income from your investment property. So all reducing your home loan. You know, an investment property's got 2 components. There's the land, and when you buy the land in your investment property, hopefully you're picking a location where you anticipate it'll go up in value. That's the reason you're buying it. The building or chattel, the fixtures and fitting, all that technically goes down or depreciates as it gets older. It's considered a tax-deductible loss. But over time, and you get to write that loss off before, you don't write the cash off, but you write it off from an accounting perspective, and it saves your tax. The building, the roof, bricks, materials, and fittings, including carpets, ovens, cooktops, dishwashers, clothes, washer dryers, blinds, they all depreciate in value as they get older. You can claim this depreciation at tax time. Then you can claim your PAYG variation. As a PAYG income earner, you get to claim this depreciation whenever you get paid, whether it's weekly, fortnightly, or monthly. This could be $100 or $100 a week or $100 a month into your pocket. So that you take that extra savings from claiming from your PAYG, you get a depreciation schedule done up, give it to your paymaster, and you put it into your home loan offset account, and you're saving interest on that money, reducing the loan. You're reducing your taxes legally against your income, and you're paying off your home loan. So why wouldn't you do it? It puts money in your pocket. You'll need to get a depreciation schedule that'll cost you about $500 on your investment property, and then you can claim the variation. Structure in the depreciation schedule is also tax deductible. Structure your finances correctly to reduce your taxes and help pay your bad debt sooner. Rule number 8, avoid debt consolidation unless absolutely necessary. Debt consolidation is when you use one bank for 2 loans, for your home loan and your investment property loan, and it's consolidated into one loan. You want to avoid that. Rule 9, avoid cross-collateralization, which is very similar, but it's not. It's 2 loans, and the bank has the collateral of both properties for the 2 loans. And beware of the all monies clause. And an all monies clause allows the lender to use your home as security against any other debts you may have in the future loans you may take out with this lender. So that's the all monies clause. And a lot of times when you're really pushing your finances, you want to buy another property or something, you're pushing maybe a little bit too hard, the bank will throw this all monies clause. And then if something goes wrong in one property, they can come after your house. And you want to avoid that. Rule 10, have your home and investment property loans with as many different lenders as possible. That's when each investment property in your home loan is a different bank, and they're separate. There's a wall between each one. Be aware of the LMI trap. That's lender's mortgage insurance. Sometimes if you are borrowing more than 80%, which the banks will partner with you more than 80% of the property, that's how confident they are in property, but they are worried about your income, they will ask you to take out lender's mortgage insurance. And if you refinance, sometimes they will trap you in after paying for the insurance. They won't let you transfer it over to the next property, so that you can get trapped and not be able to refinance away from them. Keep income as long as possible in your offset accounts, and keep your savings in the redraw facilities to avoid having to go back to your lender to refinance when you want to release additional equity or need a deposit for your next investment property. State of offset accounts and the redraw. And so you're running your own show. It takes management. In the beginning, we talked about discipline. That's what it takes. But you make a lot more money. To find out more, please feel free to call me directly. My name is Jerry Parker, Capital Growth Property. I've been in real estate for over 25 years, building my own property portfolios and helping others, my clients, do the same. Please feel free to give me a call. I'm happy to work with you in locating a property and building up your portfolio and your property business professionally. Thank you very much.